well, thank you guys. I appreciate every single one of you for coming out today. This event was presented by ABCD Committee, the Advancing Belonging Community and Diversity Committee. Would you mind just giving yourselves a shout out by raising your hand that you're here? If you ever have any questions, these are the people to go to in regards to more information about joining our committee. Our goal is really to educate our community in many different ways to advance them to becoming homeowners, which is usually all of our goals, which is why we're here today. Q&A will be reserved at the end just because we have so much data to go through. There's so much information in the slides that they're going to be available on the website as well at the end. Few housekeeping, you have a sheet really quickly, fun fact sheet. If you don't have one, please raise your hand and we'll get somebody to get some to you. Anybody two? All right, we'll get those. All right, cool. On top of that, we did print some stickers. If you guys want some, just a quick swag shout out. All right, and then we'll get started. I wanted to introduce our presenters, our panel today. So I am Belle. It's really nice to meet every single one of you, beautiful faces. Then we have Dan Gutierrez with CMG Loans. Ashley Hurtado with Guardian Mortgage. Jen Hernandez with CMG Loans. And Mike Torres with Home Funding Corp. I think everybody got his card. All right, let's get straight into it. So Dan's our first presenter. He's going to get into financial literacy and macroeconomics for real estate. Oops. There we go. Let's give an applause for Dan so he knows.
Thank you, Belle, very much. It's a great honor to be here. And I'm very excited. I developed a course almost a year ago called Mortgage Rates in the Fed in Today's Economic Cycle. Essentially, it's a macroeconomics course that is geared towards the dynamics associated with the economics behind mortgage rate movement and how it correlates directly to the real estate and lending environment. So after teaching this course for almost a year, and of course, as you realize, as dynamics change, and new policies are integrated, and as we move further along into the various phases within our economy, things change. So I get to revise it often, and as you know, economic news is that's irrelevant, happens every single day. So I'm going to get right into it, and the goal here is to teach on something very essential and very macro-oriented, and that is going to be the 4 phases of the economic business cycle in America. Many people don't know this, but it's like the seasons of the weather. Once you have an idea of, what happens in summer, what happens in spring, fall, etc., you can apply that to economics, and you can know exactly where we are in our economic phase within our business cycle and know what happens during that season. Just like if we were in summer, it's going to be hot. You're probably not going to get a winter. There are certain things that are relevant that you can sort of identify within these phases. So I'm going to get started with this, and we'll get rolling here. Let's see if I can get this right. Advanced slide. There we go. So my favorite literateur, Mark Twain. So history doesn't repeat itself, but it sure does rhyme. Now that can be applied to economics, to mortgage rates, because everything is cyclical. Things run in cycles. I hear all the time, well, we're in a political election cycle, so yeah, this is going to happen or X is going to happen. We have all these odd sort of ideals of what happens during an election cycle because of an election cycle and how it affects the economy. All right, so I'm here to tell you that election cycles don't have a lot of bearing on the economy. As you'll see, that these phases run through that are completely independent, really, of what goes on in politics at large. So let's get started. All right, some of the things we're going to cover in economic fundamentals is the impact that it has on real estate sales and, of course, providing us with a bearing on the position that we are in, knowing where we are in this phase and what to expect next. And really what's important, too, is becoming conversant on this topic. There's so many talking points, and sound bites that sometimes you gravitate towards. The media puts everything out in a blitz, and we'll say a few catchphrases. So you'll hear these catchphrases, but there we go, thank you. But there's never, really any teeth behind it in knowing, what's going on. So becoming conversant in this subject, I think, is very important for realtors and, of course, lenders as well. I'm also going to provide a structure for us to navigate the technical inflections that occur within our economy. And this is really what the media puts out. Technical inflections are things that happen. These are dynamics, variables, if you will, that are really outside of the fundamental structure of economics and how our business phases roll. So we're cutting through the noise, and we're going right to fundamentals, and we're getting a baseline understanding of why mortgage rates move and what causes them to move, and what goes on in the economy that causes all of that. And then lastly, the goal is to be able to educate those that we work with, those of our clients, prospects. Having this knowledge and being able to become conversant and explain what's going on really takes the ambiguity out of what's going on in economics and interest rates. There's just so much out there. So hopefully by the time I finish this short 20-minute presentation, maybe 15 minutes left, you'll have a good baseline for that. I also teach this class. This class is offered, this is really a segment, 20-minute segment out of probably, my 2-hour course. But this course is going to be offered, and I'll be teaching this course in October here at GAR. So I encourage you to enroll in that. I want to take you back to June of 2023, a year ago. A year ago, all of the chief economic analysts within our industry and beyond, they all said one thing, and they were very common in what they were espousing, and that is that mortgage rates by the end of last year, we're going to be in the 6s or below. You can see some of the information that's put out. Freddie Mac, chief economist Sam Cotter, said that rates are coming down. Rates should gently decline over the course of 2023. This is said back in 2023, June. That is. You have NAR saying mortgage rates will drop, with the 30-year fixed mortgage rate progressively falling to 6% this year and 5.6% in 2024. You can go on. You can see rates at 5.25% falling. Well, why didn't this happen? I mean, we've got some big names here. We got Bank of America, who hires global research. We've got Zillow saying rates were going to be that low. Why didn't that happen? I mean, these guys are intelligent. Well, what happened is that they didn't realize how long it would take for the Federal Reserve to get to their base, or rather their target rate of inflation for personal consumption expenditure, and that's 2%. Do you guys know that? 2% is what the Federal Reserve wants the inflation figure to be before they roll into a quantitative easing pattern. So what we've been in is a tightening pattern. So what does that mean? Tightening and easing. What that means is the Federal Reserve has a dual mandate from Congress. That dual mandate is to manage price, which is inflation, as well as employment. So they manage both of these throughout the long term to maximize both. Now, if you get the economy too hot, you get inflation. If you get inflation, you get prices that are too high. And eventually, businesses contract and they start to lay off workers, and you have unemployment. So these are cycles that are managed by the Federal Reserve, and that is their dual mandate from Congress. So if we looked at this a little closer, I want to show you this graph. Now, take a look at the green line. This is the federal funds rate. Now, this is the key here. The Federal Reserve, through its FOMC, the Federal Open Market Committee, sets monetary policy for the Federal Reserve. What they attempt to do is, in moderating employment and also price, i.e. inflation, is they will manipulate the federal funds rate. You may have heard of that. What is the federal funds rate? The federal funds rate is the rate that banks lend to each other overnight, on an overnight basis. So that particular rate set by the FOMC is a rate that sets the baseline for all other rates and indices. You'll see that the Treasury, the 10-year, the 2-year follow this. Mortgage rates follow this. Not lock and step, but it's a very large macro effect on the economy that causes mortgage rates to move. So when the Federal Reserve is in a tightening pattern, and they get in a tightening pattern when they need to shut the money supply down. Why would they need to shut the money supply down? Why would they need to slow spending down? Well, they do that to curb inflation. We had inflation was at 9.1% in May of 2022. And the Federal Reserve at that point and they received a lot of criticism that they moved a little too late. But the Federal Reserve started to tighten. Tighten means that they started to elevate the federal funds rate. Now, when they began to do this, the goal is to slow the economy, to tame inflation. Now, inflation is the arch enemy of long-term debt securities like mortgage-backed securities. It also erodes price in every other way. So inflation is a bad thing. So inflation came down. So let's take a look at since 1996. We've had a couple of recessions. You guys might remember some of these. So you'll notice that this green line is the federal funds rate. So the Fed up here at 5% in 1996. Look at this. They started to raise the federal funds rate. They started to attempt to slow the economy down because inflation crept in. They're always a little late. They're behind the curve. It's like steering the Titanic. You know, once you start turning, it's just very slow. And by the time you get out there, you know, you got to sort of get a benchmark to see what the effect was. So you'll see that in 2000, everybody remembers that market, right? So you see the Federal Reserve dropping the federal funds rate. They're lowering that federal funds rate. Now, the effect that that has on the economy and mortgage rates is that mortgage rates start to come down, okay? We all want mortgage rates to come down. But when this dynamic occurs, there's also a diametric side, and that is that we usually get a recession. But don't be afraid of recessions. Everyone's afraid of a recession. Now, we don't want a bad recession. Nobody wants that. But we've got to have a winter within our economic cycle. Otherwise, we can't start the process anew. And it just goes over and over again. There's only 4 of them. So you can see that Federal Reserve is bringing the federal funds rate down right here. They're bringing it down to about almost 1%. Mortgage rates probably at about 4%, okay? So this is maintained for a period of time until the Federal Reserve sees that inflation, again, is creeping up into the economy. So when inflation creeps up, the Federal Reserve begins to tighten. So they eased here, brought rates down, eased, okay, QE. So now they tighten here at this phase because we've got inflation. And the way that we tame inflation through the FOMC is that we increase the federal funds rate. And that slows spending because interest rates are high, you know? So it really is a dynamic of the free market economy. It's really not a manipulatory effect that the Federal Reserve is participating in. It almost seems that way, but this is totally Keynesian economics, okay? All right, so I want you to note this pattern. Here it is again. Interest rates go up. The Federal Reserve increases its federal funds rate. Okay, here we're at 1%. The Federal Reserve increases up to about 5%. Who knows what the current rate is for the Federal Reserve, the overnight bank rate? Who knows it? What is it, Tigo? 5.2. That is correct. It is 5.25. Ding, 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 ding. Someone give Tigo a prize. He gets another sticker to put on his lapel.
Need more stats?
Hey, I'm going to start asking for some. We're going to get there. All right, so look at this beauty. Look at this beautiful thing right here. This is what everybody loves. This flat line right there. Look at that long run from 2008 to 2016. Federal funds rate at 0.25%. Okay, 0.25%. Wow, that is so low. So mortgage rates are under 3. Isn't that exciting? But we're in a huge recession then, obviously. And the Federal Reserve began to tighten up in about 2017, began to tighten because of inflation. But oh my gosh, what happened here? The Federal Reserve midway had to take an action because of something that happened. What happened here, guys? What happened here? COVID-19 pandemic, right? So what did the Federal Reserve do during this time when unemployment is at an all-time high? I mean, businesses are closing down, fewer and fewer jobs. So the Federal Reserve starts to bring this baseline down to help the economy out. So when the Federal Reserve brings the rate down, the baseline rate, Federal Reserve rate, that is to encourage economic activity, okay? And when they increase it, it is to slow or dampen economic activity to control inflation. Remember, dual mandate, price and employment. So you can see that during COVID, rate comes down to 0.25% here, and mortgage rates, what? Around 3? Sometimes a little lower. Wasn't that exciting? Everybody wants to see that again. So this is a dynamic that occurs within a business cycle. There are 4 phases. You can see that the amount of time between cycles, and by the way, these lines right here, who knows what these little gray lines are right here? What are these? Can anybody name these? What are those bars up there, Tigo? That's right. So if you ever look at an economic chart or a financial chart, and Tigo never looks at financial charts, you will see these. You can discern these. Every time you look at a financial chart, those little bars up there means that was a recession. So if you looked at these these periods of time, you'll see how long it takes to get through a business cycle. And I've got some stats on that for you. We've had 52 recessions since the Federalist Papers were signed in 1778. How am I doing on time? Oh my gosh. Okay, we're going to run through really fast. Okay, so I'm here to tell you that the movement of mortgage rates is nothing more than economics. Cycles that are recurring and predictable. These are fundamentals. So the 4 phases of the economic business cycle for America, and by the way, the rest of the world follows it. We sneeze and the rest of the world catches a cold. This is our cycle, and the rest of the world is right in line with this, okay? In fact, Britain's a little ahead of us right now. Their economy is smaller. So I'm going to skip this. Inflation right now, 2.5-ish, okay? It's a little lower. It's coming down about 1/10 every month. The Fed wants 2%, but we may see a drop in September when the FOMC meets on the 17th and 18th. Not because we're quite at 2%, but because we're going to be at 2% soon. Remember, it's that long turning Titanic when we start making a turn one way or the other. Okay, I'm not going to spend a lot of time here, but you can see the federal funds rate here. This is actually a speculative chart here towards the end, showing exactly where we think it will be. There's an inverted yield curve right now where the 2-year Treasury is outpacing the 10-year. And that shouldn't happen because a longer-term maturity should have a greater yield. But now we have the 2-year has had a greater yield than the 10-year. And that's called an inverted yield curve. That signals a recession between 10 and 13 months lag time, and it has 100% of the time in the last 60 years. 8 times in the last 60 years. This is the only time that it hasn't yet. And the last time it was actually, I think, early 1960, I believe. So, but it's coming. But it's not going to be bad. And I know it's not going to be bad because we're easing into this contractionary period. We're not abruptly hitting it like COVID or the Great Recession, mortgage meltdown. All right. Inflation up to 20%, up 22%. Can you see that in 1980s? Pretty amazing. So can you see bars there? They're not really coming out, but you can. There's recessions that are in here. I'm going to skip forward to right to the meat, okay, guys? This is our business cycle. You can see there's 4 phases. I'm going to get into the first one really quickly. The first one is expansion. Expansion is a phase in our business cycle that we are not presently in. Technically, we may be. I'll explain. But basically, on an expansion phase, that is a time when GDP is rising, and it's essentially a boom time. That's when things are ramping up, and there's a lot of activity within the economy, and it's a very, very good time. GDP is rising, and then we see something that happens as we move outward into that business phase, the expansion cycle. We get into a peak phase. And the peak phase is really an extension of the expansion phase. During the peak phase, that's a time. It's kind of like I would say it's like when the sun is going down, if you will. So the sun is setting, and everyone wants to get that last little bit of sun, and they just don't want it to go away. But it's not good sun. It's the kind of sun that's kind of, blinding you, and the light is weird. In a peak phase, that's when we top out. That's when we start to get inflation, and it starts to get high. It gets to the point where the Fed realizes that they've got to do something about inflation, and so what do? What does the Fed do when inflation gets too high? Anyone? Somebody? What does the Fed do? They raise rates. That's right, they raise rates. So in a peak phase, that is when the Federal Reserve increases the federal funds rate. So in this phase, in May of 2022, the Fed began to raise 0.25%, 0.25%, 0.75. They took us from 0.25% all the way to, Tigo says 5.25, and that's exactly where we're at right now. So we got mortgage rates, 7%, 6.5%, as high as 8%, with a 5.25% to 5.5% federal funds rate. What's it going to be when it goes down to 0.25%? But will it go to 0.25%? I'm thinking not quite 0.25%. During this peak phase, the Fed increases the federal funds rate to tame inflation. Inflation has effectively come down from 9.1 to just under about 2.57 right now, okay? So it's going in the right direction. We haven't really felt it yet, and I can talk more about that. Okay, I'm running out of time, but quickly, contraction is the next phase. This is the phase that we're heading into. We haven't quite gotten into contraction yet because even though GDP has slowed and the jobs numbers have cooled, consumerism has come down, and really it's all about the consumerism. When Americans are spending money and they can't stop, we get this effect where this long-lasting, sort of, sunset effect takes hold, and it's just a long phase before we can get into this contraction. Everyone wants contraction right now because everybody wants low interest rates. So realize what you get with it. You get a contraction phase, which is a recessionary phase, although recession, by the way, you notice what recession is defined by. Recession is defined by GDP coming down, lowering, going down for 2 quarters in a row. That's 6 months. On the 7th month, we officially are in a recession, okay? During COVID, we are at month 8 in that phase, and GDP began to rise. So the Federal Reserve is doing a very good job, despite pundits, of how they manage inflation and employment. They've done a very good job, in my view. Maybe a little slow in starting to quantitative tighten, but they can make up for it if they give us a quarter at least in September, all right? So contraction phase is coming, and the Fed is going to begin to decrease the federal funds rate. We head into a recovery phase where we enjoy all of those benefits, and we really could enjoy this period of time for probably, I'm going to say, most of 24 and most of 25. These are expected to be the biggest years in real estate, even more in lending, even more so than we saw in COVID when rates were at 3%. Why is that? We've got millennials, age 35, median home purchase age, massive, bigger than the baby boomers, and they all want to buy. Secondly, we've got interest rates that'll come down. And thirdly, inventory. We know that sellers will begin to leverage, become buyers themselves, sellers and buyers, when rates get down somewhere in the 5s. So good times ahead, excellent times, in fact. All right, guys, that's all I have for here. I teach this class next month, and I hope that you guys can attend. Thank you very much. That's it.
Oh, as I would tell my daughter, what a smart goose. Okay, let's go for it. Okay, so affordable housing in today's market. Basically, I just want you guys to know where to get these stats that I'm getting to. So we'll go to the first section, the beginning of MLS. As of yesterday, there was 2181 properties on the market. I'm sure that the attached versus detached, Tigo knows every single day. So. Anyways, that being said, we'll go to market trend graphs. Can you see that section right here? That's where we'll be heading to look at the seasonality of the market trends. That being said, kind of using our cheat sheet, we'll be able to see that these exact expansions, peaks, contraction, and recovery periods have been in our market as of today, our real estate market. This is our local market, so we're going to take it from local kind of to national, back to local. So that being said, if we're looking at number of listings, you could see here that we're a little bit low. Skipping a little bit, a balanced market, around 6 months, 5 to 7 months worth of inventory, that's what they say. Buyer's market under that, sellers market under that, buyer's market over that. Sorry, I was thinking in my head. That being said, if we go back to days on market, there was a period right here in 2020 to 2021. We know exactly what happened. You can see in our charts where everything changed. Things have been recovering since then. So you can take these graphs and show them to your clients that since then, our months of inventory have really just not recovered. We're still right now in a seller's market based off of the 2 to 3 months worth. So if we're here 2 months, we just still really haven't gotten to that 3 months period yet. Let's see. Oh, I wanted to tell you guys. So my story, I bought my house in May of 2018. I bought it for $135,000. Shortly after, we know exactly what happened, right? We can see it in the charts. We have no problems. I had to sell my house in March of 2022. Can anybody take a guess as to how much I sold my house for? In Rio, okay, good question. Rio Rancho, valid. Rio Rancho off of Rainbow and Southern. Who said 260? Ooh, 265. So from 135 to 265, I was, yeah, no. And that was the reality of the situation. So I was able not, just like most sellers right now, that's they're high in equity right now. They don't really know what to do. Some of them want to hold on to it, especially the ones that are in a fixed income. Fixed income being like disability and so on and so forth. We want to try to help as many clients as possible, but that being said, they're at a little bit of a disadvantage. So that's why we talk to lenders with unique lending opportunities to see what we can do to help them. And not just that, also bring them the reality of their situation, you know, the reality of where we are in the market, the reality of their budget, the reality of their needs, the reality of their wants. A good financial advisor really let me know that right now, needs and wants are at two opposite sides of the spectrum, and the reality is we need to show them that if they want, you know, and we're talking about a set group of people, the ones that need a little bit more help financially. If they want to be in these same classifications, well, we have to grind a little bit harder, and this being these charts are why. So that being said, let's see. Okay, we're still here. One more story to tell you. So I had a client. For a year, we started right when the pandemic started. We really didn't know what was going on. All we knew is that his job was secure, and we needed to find him a house. Well, 15 offers later, and a year later, we still hadn't found him a house. And I truly mean we were grinding hard. There was somebody showing the house, we were already there, and we could see the line of cars out just like all of us experienced. That being said, that last house, we were there standing in the garage, in front of the garage, writing the offer within 15 minutes, sending it out. And because we were the first offer, the seller's agent was like, yeah, we're seeing the exact same offer now, so we're just gonna pick yours because we just don't wanna deal with it anymore. That was the reality of that market that we're still recovering from. So that being said, I don't think that's mine. Okay, so we went balanced buyers, sellers. That's my phone. Okay, so now we're going to compare a $300,000 house then and now. From 2014, 10 years ago, to a 2024 comparison in the Cabazon area. So in 2014, we were able to close a house for $300,000 in 9/4 of 2014. It was a 4-bedroom, 3-bath, nearly 4,000 square foot home, and it's nice. We can admit it's a pretty nice house. Nice kitchen, you know, you could see the details were really added. That being said, now we go to 2024. The list price is $300,000. Well, we're going for a little bit above that because that's our market now. 2 bedrooms, 2-bath, 1,224 square foot within minutes of each other. This is the only house that I could find in comparison for $300,000, by the way. I tried. So that being said, this is your house. Going back. Going forward. So again, we go into needs and wants. What's the reality of what they can afford right now in today's market? You know, help them grow into the future. That's when we start talking to them about what they can budget into, what they can retract from their budget. So this starts going into, we'll go into your client's financial. So sometimes as salespeople, we put on various hats. Sometimes it's just as much of a financial advisor hat, whether or not you can do it, just as much as it is, you know, your real estate agent as your friend, a psychologist at times. It just really, really depends on what's going on with your client and their needs. That being said, when we're talking to our clients, sometimes it's nice to give them some resources. I can't directly do this for you. You have to want to do it yourself. You have to want to better your situation. You have to want to try. But here's a resource or two to get you there. Are you in the position to be able to afford a house? A beautiful quote that I really like to say is from Jada Pinkett Smith. She always used to say is, yes, I could give my family a house absolutely, I could buy them one. But can they afford the mortgage payment? Can they afford the utilities? Can they afford everything else that comes along, the maintenance, the yard work, the taxes, and it all adds up, and it adds up really quick. All of a sudden, our check that just came in, our commission check, is out the window to the cats. Just not from experience or anything. So that being said, if we're going back to our statistics for our market, in New Mexico, our median income is $59,000. It's a little bit less than the United States average, which is $74,000. So we're just under the poverty. Our poverty rate is like 14%. That's what I said. It's not in here. That being said, most of us commute around 30 minutes. So as real estate agents, we know, that we got a little bit more of a circumference average that we could really help them into. Most people say they want this specific area, but we've noticed that they kind of venture depending on what is available, and we really don't ever want to pigeonhole them into a specific area. We just want to guide them into the reality that most people commute 30 minutes from wherever they need to go, and that's from work. Okay, quick question. Does anybody know what the rental average is in the state of New Mexico? Based off of United States Census, at the full average, what we're paying for rent in the state of New Mexico? $900. Okay, how many of us get that call that we want to buy a house within a budget of $1,000? Give us just... Yeah, so that's probably why, because the reality is that at least statistically half of them are paying $900 for a mortgage. Does that skewed? Absolutely. Once we get into like the 3 bedrooms, 2 baths, where we are looking in the thousands, $2,000 range, depending on the area that you're searching. But that being said, $900, that's the average based off of U.S. Census. So that being said, how many of us get the call and they really just don't know, your clients just don't know where they are financially? Raise your hand. Yeah, absolutely. That's the problem that we would like to offer you guys a solution for. So that being said, in your sheet, on the second section, you have a few calculators and a few resources to give your clients. So when they're saying, I have no idea what my budget is, I have no idea what our household income is, I have no idea where my, what account is doing what and what should be doing what, well, here's a start. Another resource I will offer you guys is a free financial advisor. If you guys don't already have a financial advisor that you guys refer out to, because we can only know what they tell us, right? The tips and tricks, which is needs, wants, budget, don't budget. It's all completely up to you. But the reality is that they need to put it into play. So if you guys need a financial advisor, let me know at the end, come find me. I'll give you guys the resource and just send them there. Let's get them started with something. It doesn't have to be you. You really don't have to take on that hat. Although it seems like we do, we really don't have to. And it makes us seem smarter. It makes us seem more educated. It makes us seem resourceful to outsource this information, especially to somebody that's reliable. So again, if you don't have somebody, come look for me and I will get you that information. So that being said, we're gonna go to, okay, so our homeownership rate, on a side note, is a little bit higher than the United States average, which at first I was kind of shocked about, but it does make sense when we're talking about legacy transfers, the houses that have been in the family for generations. We're really prideful as New Mexicans. I've been here for a while, so I can say we, I hope. As New Mexicans, to hold on and cherish what we hold, what we have. So that being said, there's a lot of wiggle room that we have as real estate agents in the vacant units. So I believe Dan is going to talk about 203K loans. That being said, we have 100,000 vacant units right now. So we have some play if we really wanted to get down and dirty and in the mud to try to rejuvenate and bring some units back into the community that we are already in shortage of. I mean, we're already in shortage, and then we have 100,000 units vacant that could have something to do with it, and so on and so forth. Why not, again, use these resources to accomplish that? Our employment rate is 54%. It doesn't say it here. Our unemployment rate is 4% in New Mexico, and in the US, it's 4.3%. I believe they wanted to keep it under 2%. Tigo, do you remember? No? Okay, I'm thinking of a different statistic. All right, so then, sorry, was it 4? Maybe, that makes sense. Okay, so that being said, budget breakdown, that's their first sheet. Talk to them about their fixed expenses versus their variable expenses. The fact that things are going to change even when they buy a house. A lot of people don't expect the fact that at some point your taxes are going to change in a few months, years, whenever you buy, depending on that season. It's just important to talk to them about, are we planning to buy? Are we planning for a family and to buy? Or planning to become our own boss? Some of us are. This is a good sheet. This is what I started with when I became a real estate agent. I kind of just started with, I have one for business, I have one for personal, I have one for my family, and it just kind of helps me guide to make sure that I am properly budgeting myself for my future. So I have a wedding here coming up. Again, I'm budgeting for that large miscellaneous expense. We just bought a house. That was a big, fascinating experienced expense, so on and so forth. So every single time you guys have a situation where you guys need to refer back to this, please use this Budgeting 101 worksheet for you and your clients. And like I said, it just goes through all of this in a nice, comfortable manner. And then it goes into multiple savings accounts. You can help them automate. I don't have an emergency fund. How can I get an emergency fund? Not you directly, but you talking to your financial advisor and you guys coming together to work out a plan. That being said, even the FDIC has a calculate my net worth. They believe that calculating your net worth can be, I forgot what I was saying, measure. Okay, yes, it's a measure of financial stability. It could be a positive, negative, and in the middle. That being said, what can we learn from that? I had my notes here. Sorry. Okay, so that being said, what I like to start with every single one of my clients is something simple. I say it in Spanish, so give me a second. In Spanish, it's no quiero sacar la comida de la mesa. I don't want to take the food away from the table. So I don't always get referred the $800,000 client that can go buy tomorrow that's coming in from out of town. I had that experience. That was fun. Those are great. We don't always get those, especially in the state of New Mexico. We usually get the budgeted fixed income, so on and so forth. You really have to get down and dirty and say, these are my fixed, this is what you're telling me your budget is. This is what you have potentially income-wise. This is what you have potentially income-wise. We have a variable of this much amount to play with, so how much do you want left over to feed your family at the end of the day? And because they are so limited, we really are talking about a few $100s sometimes. So let's work through that and just talk to our clients about that. So that being said, this leads into unique financing options. There was so many to choose from, so we just didn't have enough time. So that being said, we decided to do Section 184, USDA loans, I-10, manufactured homes, home funded program, and 203K loans. So that's our beautiful panel here today, and we're going to start with Ashley. Four percent. Thank you. Good. Thank you.
There we go.
I knew I had it Google somewhere.
Awesome, you guys. Well, thank you so much for going ahead and having me. I'm going to go over 2 different loan products that I go ahead and offer. That's going to be the Section 184 and the USDA loans. So first, we'll start off with Section 184. So with this section, we're going to be going over a few different things, just really simple. What is Section 184? Who is eligible for this loan? And the pros of this loan, as well as some fun fact or fiction to test some of your guys' knowledge, because I know some of you guys have probably already done this one. So the Section 184 loan is going to be a guaranteed program that is created for Native Americans in 1992 to go ahead and address the lack of housing and mortgages in the Indian County, and Native American home ownership has always really been a really underserved market. A lot of people have gotten land passed down from them within the Native communities, and they really couldn't do anything with it until this act had been developed. So who is eligible? So borrowers that are eligible have to be currently enrolled in a federally recognized tribe or be an Alaskan Native. So have you guys ever seen them? They're gonna be little ID cards that have to go ahead and have their picture. They have to actually have that recognition through their tribe, because there used to be a lot of papers that were given out and just telling people their blood quantum. That's not enough for this program. They're gonna actually have to go ahead and reach out to their tribe and get enrolled. So what are the pros of this program? So the pros of this program are really gonna be a lower down payment. So just depending on exactly how much they're trying to go ahead and finance, sorry guys, I have a problem with this clicker. It's gonna be 1.25% on $50,000 or less, or 2.25% on loans that are gonna be $50,000 and higher. They do have to still have a minimum of a 580 FICO score. They can be used, these programs can be used to either purchase a home, rehabilitate a home, do new construction, or do a no cash out refinance. So they're gonna be refinancing it just for a better rate, maybe to extend their term, maybe to even shorten their term. So no cash out on that. If they're looking for cash out on a refinance, they're gonna have to go regular conventional FHA, something along those lines. There is a mortgage insurance on these loans. It's low. It's really low. It's probably one of the lowest mortgage insurances that you guys actually can at 0.15%. There is also a upfront guarantee of 1%, also known as like a financing fee. It can actually be paid at closing or included in the loan amount to be paid throughout the life of the mortgage. So we'll go ahead and do some quick fact or fiction. Section 184 loans are only available in counties in New Mexico. Fact or fiction? Fiction. So Section 184 loans are eligible anywhere in the state of New Mexico for New Mexico, anywhere in the state. Other counties and other states are different. That one sometimes goes county by county. All of Oklahoma, if anybody wants to do anything in Oklahoma, the whole state is eligible as well. Oops, I don't know what I did. We can all go home. I broke it. Thank you. So next fact or fiction, Section 184 loans are not available to purchase property on the reservation. You guys are good. Fiction. You can go ahead and buy a new home or start to go ahead and build your own home. You do have to get approval from the tribe. So you have to get everything cleared by not only your lender, but also the tribes that you're building your land on. So Section 185 allows for DTIs over 43%. Fact. So anytime you have a higher debt to income ratio with this program, you're gonna need a strong profile. You're gonna need reserves, you're gonna need strong credit, you're gonna have to have minimal payment shock. What is payment shock? Payment shock is what you're actually paying right now compared to what you will be paying with this new mortgage. So the closer we can stay to your original payment, that's gonna be best. Section 184 loans are only available as primary residence. Can anybody buy a vacation home? Correct. Fact. So you're only able to go ahead and get a primary residence with this loan, and you can only really get one loan at a time, unless, of course, your significant other or somebody else that you're buying with is also a Native American that is going to go ahead and be on the loan with you. Awesome. So that goes ahead and covers our quick rundown of the Section 184 loan. Next one we're going to go ahead and do is USDA. So in this one, we're just going to cover the exact same things. What is USDA, who is eligible for USDA, and the pros of the program, as well as some fact and fiction. So the USDA loan is also known as a Section 502 direct loan. This program goes ahead and helps low, very low, and even moderate home buyers. That is going to be their income. What it's created for is to provide safe sanitary housing in rural locations. Usually, historically, rural locations are just underserved communities. They don't have as much funds and they don't have as much county funds available to them. So who is eligible? So people that are under 115% AMI for the area are eligible for this program. What is the pros of a USDA loan? So the pros of the USDA loan is 100% financing. We can even pair these loans with different down payment assistance programs to be able to go above 100% loan to value and cover some of those closing costs as well. For this, we're going to need a minimum of a 520 credit, or 580, I'm sorry, a 580 minimum credit score, and then we can only use them for purchases and rate and term refis. Again, this is another program that doesn't allow for cash out. You do have mortgage insurance. It is, again, really low. It's going to be lower than FHA's. So the annual mortgage insurance for this is going to be 0.35% yearly. There's also, with this program, a guarantee fee, also known as a funding fee. Same thing with USDA. It can be paid at closing, or it can go ahead and be rolled into the loan amount. So here's some fact or fiction for you guys. USDA loans are only available for first-time home buyers. Fact or fiction? Fiction. USDA loans are available to any buyer that meets the household income limits and property guidelines. USDA are the best loans for a rural property. Fact or fiction? Fiction. USDA loans are a great program, but it's not going to be a fit for everybody. If you have a borrower going ahead and coming in, they have a high credit score, and they're going to be putting 20% down. You're not going to want to go with the USDA. You want to go with a regular conventional loan. You're going to save them that funding fee, and they're going to go ahead and get rid of that mortgage insurance a lot sooner, even if they put less than 15% down, than they will do with this USDA loan. USDA loans are only available if you are purchasing a primary residence. Fact or fiction? Correct. USDA loans, like the other government loan that we just looked at, are only available for primary residents. And that's all for me, guys. Thank you so much. We ran through that really quickly. You guys know your stuff. Hi.
Hello, everybody. I brought notes, but I printed them too small, so if you see me struggling to read, it's because I can't see that far. I'm going to have to be looking at this screen here. So I'm going to be talking about the ITIN loan. And my name is Jen Hernandez. I think I know most of you in here. I'm with CMG Home Loans. Thank you for coming today. Unlocking opportunities with ITIN mortgage lending. ITIN stands for Individual Taxpayer Identification Number. It's a tax processing number issued by the IRS to individuals who are not eligible for a social security number. It's used by non-citizens required to file U.S. tax returns, and ITIN holders are often hardworking individuals who contribute to the economy. ITIN Mortgage Lending Overview. It's designed for borrowers with ITIN or a joint application with a combo of both. So if you have somebody whose social security number and then the spouse has an ITIN, we can do that. It's they can apply together. Eligibility criteria, they have to have a valid ITIN, stable employment and income. LTV varies between 85 to 70%. The minimum credit score is 600, but we can also do no score, and that's treated as a 620. Benefits for buyers, access to home ownership. ITIN loans enable non-citizens to own homes. No social security requirement, allows for mortgage qualification without a social security number. Credit flexibility, lenders may consider alternative credit histories, and no score is okay. That is a big, common question that comes up. What happens when they don't have a score? It's no score. We can do it. Financial growth, homeownership helps build wealth and community roots. So the benefits are pretty much the same for somebody who's coming in with a social security number. Some quick stats, and I love this here. So the percentage of ITIN loans that close is in the high 90s. I couldn't get like an actual number, but like 97% was pretty good. There are $7 billion on the books for ITIN loans. Percentage of on-time payments is 99%. So these folks who have to work a little bit harder to prove that, they will repay this loan, like they are, I don't want to say worthy, but like they want to buy a home too. They're so grateful, like the payments on time, are at 99%. Income types, we can use tax returns, you can be self-employed, we can use P&L. You have to have a 2-year work history and at least 30 days at your current job, because sometimes you do find that, they move jobs. So as long as they've been at the current job for 30 days, we can work with that. And a pay history of at least 12 months. Is there an early payoff penalty? Nope. That's one of the big questions that come up too. Job change, we're okay as long as we can document a 2-year work history. Manufactured homes, we can do all of them so long as they are on a permanent foundation. This is ITIN, okay? Gift funds, okay, 100%, and it's limited to the 80% LTV. Friends and family, so this is another one of those questions that come up. Somebody purchased a primary residence with an ITIN, and now they want to buy another primary residence with the ITIN, and they're going to keep the other one. But through conversation and getting to know them, they're not going to be the ones actually living in that other property. They have family that are, moving into the country, and they want to buy them a house because that other person isn't eligible to buy just yet. They can do that. So they can own a primary, they can buy a secondary home up to 80% LTV, no minimum distance. So if they want to move the family in next door, across the street, or across town, we can do that. We just have to make sure that both of the payments it fits within their DTI. So they are, limited by that. Vacant land is okay, non-owner occupied is okay. And the biggest difference between an ITIN and a non-ITIN loan is that an ITIN borrower has to provide that letter from the IRS. So this is stuff that's it's available to everybody who doesn't fit in your traditional Fannie, Freddie, VA, FHA, conventional, USDA. I'm missing one. It's for anybody, and an ITIN borrower just has to provide that letter. That is what we need from them, along with the other qualifications. How you guys benefit by having this information and partnering up with somebody that offers this to buyers. You can expand your client base. You reach a broader range of buyers. You close more deals. You confidently confidently guide your clients through the process, and you strengthen client relationships, foster trust and loyalty for future business. And if you've done business with I-10 buyers before, you know that if they have a successful closing with you, they're gonna tell everybody about you. And their cousin's gonna call you, their aunt, their neighbor, somebody from church, their kid's teacher, they're gonna be calling you because they had an amazing experience. And we wanna be on that type of referral business. You know, that's the best kind of business there is here. And that's it. That's Mike Torres.
Good job, I'm impressed. Hello. Hello, my name is Mike Torres. I was invited by Carmen. Thank you, Carmen. I'm not as smart as all these 4 people that were in front of me, but I needed to play a song for you real quick, and then I'm going to introduce you to the shadow loans. I don't know if anybody's heard about shadow loans. Shadow loans is actually like a car loan, but it's for a single wide or a double wide in a park, on land. If they own the land or they lease the land, that's okay. So a lot of people are like, well, I don't want to be dealing with mobile homes, but sometimes you have to think outside the box, okay? And I'm going to play a song for you real quick, and then I won't take that much time out of your busy schedule because I know you're very important people. Trailer for sale or rent. I like it. That was me singing, yeah. Anyway, I've been in the business for about, I don't know how long. How long has it been, Dan? Since 97, 98. But 2 years ago, Home Funding Corporation came up with shadow loans, which, to help people. Let's say, for example, they want to buy a single wide, brand new or used, as long as it's a 76 or newer, okay? And they just have to put 5% down. The DTI, it can go up to 50%. It just depends on the credit score. The score's higher. 5% down, owner occupied. They can get a co-signer. It can be without the permanent foundation because a lot of people are like Jen, right? Jen. She said, we need permanent foundation. We don't need permanent foundation. You know what I mean? We can actually get it done. And the nice thing about it is it's a single wide. A lot of people are like, well, it gets better. We can actually do a one-time close construction loan on a brand new single wide or used, double wide or used, and put in a permanent foundation and convert it into a real property transaction. So if you want to sell the land and you find a dealership that sells the manufactured home, we can do that. Okay? Plus, I'm a nice guy. My face doesn't help me very much, but other than that, I'm a very, very nice guy. I've been here in New Mexico for, in Albuquerque since 1993. Okay? So that's pretty much my presentation. I mean, I don't have anything else other than you have your notes there. I don't know who printed all this paper, but that's a lot of trees. Oh, yeah, there it is, look right there. 5% down payment. We can finance the rest of it. Borrowers' down payment are allowed, so let's say they want to, believe it or not, they can borrow the down payment. Go to the local lender, they used to call them Blazer back then. It was a finance company. You can borrow the money, it can go up 25 years and no age limit. That kind of sounds kind of crazy, huh? Yeah, so no age limit. Other than that, that's my presentation. I apologize for not singing a song. It won't be long. It's going to be the twist, and it goes like this. No, I'm just kidding. Thank you, guys. You have a question? Go ahead.
On a chattel loan like this, obviously there's going to be a premium over traditional, 30-year fixed rate mortgage? What are you seeing interest rate wise to spread?
The interest rates aren't very, very entertaining, but if you're renting, who cares? I'm thinking
Well,
about
no, and I
8.5 to 10.5
Okay.
interest rate.
I mean, that's real estate contract prices these days too.
Yeah,
so,
yeah,
Okay.
and, you can go, what is it, about 500, 600 for the manufactured home, and about 600 for the space. That's $1,200, whatever it comes out to. And a lot of people are like, buying a house nowadays is like, $2,000, $3,000 a month? And I say to myself, what a wonderful world. Trees of green, red roses too. I watch them bloom for me and you, and I think to myself, what a wonderful world. Thank you guys. I love you. Thank you, Connie. You're my host for just for today. Tomorrow, that's it. We're out of picture.
Thank you, Mike. Wow. Wow. I'll tell you what, you definitely get the award for most entertaining, though. I loved it. Thank you. All right, guys. I want to talk about an interesting down payment assistance, down payment gift assistance program that is somewhat new, not entirely. It's been around for a bit. But the problem with with gifted funds, as we all know, is that it has to be heavily documented. We know that the donor has to provide a gift letter signed. They also have to provide documentation that they have the funds to donate. Lenders also have to document the paper trail of the funds being transferred to the recipient, and of course, documentation that the funds were received by the recipient. So it can be convoluted, and there are many people that don't like to do them, let me tell you. I've been on the phone too many times with someone's grandfather, parent, and they just want to know why I need a bank statement when they're just trying to give their daughter some money to buy a home. And these are good, fine people that aren't laundering money or doing anything criminal, and they feel that way when they have to sometimes document it. Not always, but it does happen. What if we had a program where a home buyer can receive multiple donations, innumerable amount of donations online through the use of an app where donors can contribute up to $7,500 per donor without any documentation? Does it sound like money laundering? Who remembers 10, I mean, I must say like 20 years ago? Mike, you might remember. Nehemiah, Amerigold, and Ameridream. These were 3 down payment gift funds programs that basically worked off the same premise. They were essentially nonprofit organizations that would receive a gift from the donor, and they would turn around and they would then contribute that money, dollar for dollar. They'd keep like $300, little service fee, and they would contribute the rest would go to the home buyer, the recipient, and that was it. It was a one-page document. It was a great program, and that's how we did down payment, gifted assistance. It worked out really well. So we've got that same program, and do I have a video? Hey, let's watch a video, then I'll talk more about it.
Home Funded is the first and only down payment gifting platform designed by a mortgage lender to help you buy a home sooner with a larger down payment. It's down payment assistance reinvented. Here's how it works. Start at homefunded.com and sign up for your free Home Funded account. Create a unique campaign page and tell your story to family and friends. Include photos and videos. You can connect your Facebook so it's easy to access photos and share your campaign with your network. Then you can choose to use Home Funded, Upit, or both at the same time. With Upit, you and your supporters can start shopping online from the Upit store link as soon as your page goes live. A percentage of each purchase will be pledged back to your down payment. There are over 1,000 participating retailers like Target, Petco, Overstock.com, and other stores you know and love. Upit pledges never expire, so you can set up a campaign and shop with Upit even if you don't plan to buy for a long time. With Home Fund It, you set a down payment goal and start accepting gifts from family and friends. It's easy and it's online, and anyone can give. Each contributor can give up to $5,000. If you're a first-time home buyer, you can qualify for the Home Fund It Closing Cost Grant. Eligible first-time homebuyers will earn $2 for every $1 in regular contributions, up to the lesser of $2,000 or 1% of the purchase price. To qualify, you'll need to complete a free homebuyer education course, online or over the phone, before the purchase contract is signed. As an added bonus, every time you or someone you know shares your campaign on social media through the buttons on the campaign page, you'll earn an extra $10 towards the closing cost grant. Sharing your story tells your network you're trying to buy a home and might even help you get more gifts. As a second bonus, for each $1 you earn on Up It pledges, you get another $2 towards your closing cost grant. For example, a 4% rebate pledge from Walmart now works out to an amazing 12% in value. So don't forget to tell your supporters to do all their shopping from your campaign page. With Home Fund It, you could be ready to buy much sooner than you ever thought possible. When you're ready to start shopping for a home, you can use all of your gift funds. Then at closing, any additional grants and Up It pledges will be automatically applied. Welcome home. And don't forget to invite all your contributors to your housewarming party.
How does that sound? Pretty unique, huh? Good stuff. You know, it works just like a GoFundIt page. You guys are familiar with those. So the Home Funded page is very similar. You send it out to your social media page, and you can share it on Facebook. It goes to Instagram, Twitter, all of those. And you know, this program guides the buyer, through these steps, and encourages them to post, a variety of different, subject items pertaining to buying a home, just to create more interest. And it's a really, really good program that is proprietary to CMG Home Loans. CMG developed this program in 2018, and I couldn't tell you how much money has been contributed, through various home buyers that have participated in this program. So going over just a couple items on facts on this program, will give you more information on it. So again, what makes this program different is it widens the circle. It expands the amount of gifts that a person can receive. It takes it from getting a gift from a relative, a fiance, or a close family member, filling out a form, documenting, doing all this effort with your loan officer, which we need to do in a lot of cases. But on this program, it takes that completely out of the equation. And your donors can contribute any amount of money up to the ceiling that we mentioned in any increments. They can also participate in a program called Up It, where they can use these retailers, the homeowner or the home buyer, and also donors, can shop at any of the retail stores. There's thousands, anyone you can imagine. And that retail store will also contribute an amount of money towards the Up It Fund. The Up It Fund is a maximum of $2,000. CMG will match $3 for every $1 to get you to that $2,000 range. Really wipes out a lot of the closing costs. And then, set your goal, $40,000, doesn't matter. Every time that post goes out, every time that someone is asking for a contribution, guess whose face is on that post? The lenders. No, the realtors is. Okay, both. Mike Torres. All right, yeah. So it's a really good program, a lot of visibility. All right, so this is exclusively used for down payment and also closing costs. And, again, the donors can lend money online, and really they can lend a hand to you to buy a home online. I kind of don't like your donors can lend online. So there's no checks, gift letters, or financial statements, and really that is the huge benefit to this. And there's no limit on the top end of what can be donated. So really no restrictions, no age restrictions. Our platform is available to everyone who wants to use this program. And a couple other items on this is that normal terms and conditions apply. We can use any type of loan program for the Home Funded program. These funds will seamlessly be sent to closing, for any loan program that we're qualified a buyer on. Again, there's no cap. And no concern also about tax liability because It is below the federal tax exclusion figure of $15,000 per person and $30,000 for a married couple. And certainly we'll keep under the 5.6 million lifetime exemption. Hope no one is approaching that cap. If you are, you need to be careful because you don't want to be over. No one caught that? That's funny. That was really funny. All right, a couple more things. I've got some information on this. In fact, I'm putting together a lunch and learn on this product. I've got a few more really cool videos to share and to get into some of the retail stores and some actual examples of buyers who have gone through the home funded program and purchased a home. There are many that have. So the money essentially it could either be drafted directly out of from a debit card or a credit card. Can you imagine that? Is this still working? Hello, hello. How's this? Oh, wow. Okay. All right. So again, how about that? You could ask someone to hit their credit card for your down payment. And it's perfectly admissible, perfectly legal. Thank you. Hey, oh. Another mic. Hello. All right, this is better. Thank you, Mike, for the mic. Thank you, Ashley. It wasn't Mike that gets you the mic. I know, thank you. Mike was close by the mic. Okay. I know I'm going over on time. I don't spend too much time on it. I'm going to skip that. Okay, we're going into another program. All right. Home Funded program. Ask me questions when we get into the panel section. And I'll be reaching out for my lunch and learn. I think it's going to be heavily attended. I'll probably just smoke half a side of beef. Wouldn't that be fun? Okay, thank you guys. There's Home Funded for you. Okay, looks like I'm up again. Does this need to be adjusted?
I have some flyers here if you guys want some for the shadow loans if you want them. Okay, it's $5.
Get your shadow loan here. Shadow. Okay, let's talk a little bit about renovation financing, renovation and rehab lending. This is more than just a 203K FHA loan. We talk about Fannie Mae home-style renovation as well. I do a lot of these loans, and it's surprising how easy it is to move a renovation or rehab loan. You can purchase any home, basically add any type of improvement that you can imagine. It used to be relegated to only repairs on a 203K loan and items that were non-cosmetic, but now you can pretty much do anything. Did a deal recently where we did a $45,000 horse fence in the East Mountains on a 203K FHA loan. And the buyer purchased that property with 3.5% down on the acquisition cost, which was the sales price, plus the amount of the repairs. So we add all those together, and your down payment's based on that. Really a piece of cake. We will get an appraisal based on the current value and also the future value of the repairs. So what does that involve? That involves details. It could be plans and specs. It could be also a cost breakdown from the builder. We take all that in consideration. Usually we will employ a HUD consultant, which is really important. The HUD consultant comes out and they sort of manage the project. They manage the construction. The draws go through the HUD consultant. The HUD consultant requests them. HUD consultant interfaces with the buyer and also the contractor and keeps things running smoothly. It's a really, really nice process. They charge up front, and I can tell you about what some of those costs are at a later time. So buyers can use a renovation or rehab loan for cosmetic items and items that are certainly beyond, dilapidation or deferred maintenance. Anything that a person wants in a property, most likely they can have. Let me give you an example. So a buyer comes in, sees a property, the house is perfect except, it's dated in some areas. So what do? Well, brand new kitchen. I mean, brand new kitchen. Everything, appliances, countertops, flooring. HVAC, why don't we add HVAC to the purchase? All they're paying is 3.5%. That's it, as a down payment figure on the cost of renovation. So what many people don't know about renovation loans is that on a Fannie Mae home-style renovation loan, a buyer can purchase and renovate a property if it is a second home and an investment property. How about that? So you're adding funds, we're essentially adding, to the purchase price to get to the acquisition amount plus cost of improvements to lend on that property. All the work begins after the loan closes. So here's kind of the process. So a buyer finds a property, they identify what repairs and renovations that they'd like to do to the property. HUD Consulting comes in, builder contractor comes in, come up with the price. This is all during the, even before the offer period. So it might take maybe 2 more weeks. How long does it take to have a contractor or two come to the property and identify what the work is going to be and then provide a quote? After all that's in, we get the appraisal based on current and future value. We calculate our maximum loan amount, which is the lower of 110% of the acquisition cost, which is the cost to purchase plus the renovation, or the lower of the appraised value. Now, the appraised value usually comes in a lot higher, I'll tell you right now. So usually it's going to be the acquisition cost is what we go off of. So that usually provides everything we need to handle the renovations. I've got a FHA 203K loan in process right now. Example how you can approach this with the buyer in the future. So a buyer comes to me and wants to purchase a duplex on Silver in the UNM area. So he wants to do some repairs, and he thinks at that point it might be about $45,000. If it's over 35, it becomes a standard FHA 203K loan, which is different from the Streamline. The Streamline is a cap of $35,000, and a HUD consultant is not needed. Although I really believe a HUD consultant should be involved in every transaction. It just makes it run so smoothly. So this buyer thinks it's going to be around 40 grand. Contractor says something like 60. HUD consultant comes in, finds a few more things regarding the foundation. So we're up to about $72,000 of rehab for this property, and he's only purchasing it for about just under 300. This property hasn't been touched in 60 years, I guarantee you. I saw the inspection report. Wow. So it's in process right now. So we closed on that transaction. This buyer is going to live in one of the units. He's going to rent the other one out. He's 24 years old, made $90,000 between April and the end of last year as a nurse. So he's doing really, really well. And he's going to move into that property. The one unit, his rental unit, is going to pay for the entire mortgage. So he's got this loan, and they've already started work. I haven't seen it yet, but I'd love to go by and check it out because I'm really interested in this particular property. So that would be an FHA 203K loan, primary occupancy only on the FHA 203K. Fannie Mae home-style renovation can be non-owner occupied investment, second home. So 203K loans or renovation loans are not that expensive. There's probably one more fee that is included. Most companies, most lenders will charge a 1% origination fee, and that's it. Everything else is primarily the same. We'll do a cost overrun. We'll pat the reserve account by about 10%, and if we need to use those funds, if things come up beyond what the scope of the work, then we can use those funds. And if we get that money, then it goes to the loan officer. Just kidding. Goes to the principal balance of the loan, and when it closes, and that balance is somewhat reduced because of that. Are they complicated? Not really. So a renovation rehab loan is essentially the same kind of mortgage loan that your lender would write. It just includes a construction rider. That's really the difference, and it really can be that simple. There's a lot more intricacy, of course, but it's all handled internally. And I'm really happy about, just to brag on CMG for the moment, we've got one of the best construction departments. We got full-time people that are working on these loans. So myself as a loan originator, I'm not focused on every element of the transaction. There's a lot of work that's being done. Is this cutting in and out? Thank you. I apologize for that. I didn't realize it. So they are not that complicated. They do take some extra work, and there are some steps, and there are some items that have to be dealt with up front that are very, very important, very important. And it really takes some, somebody that has some experience with them to be relevant in those loans. Okay, what else? So really, it's a standard escrow period. I ask for 45 to 60 days whenever I'm working on a renovation loan, and that's really just to give the process a little more time to ensure that we can get that appraisal done, and we have time to get the contractors over to the property. So as a realtor, you might open that door a few extra times, as the contractors are going in and all of that, but really that's it. So again, it's not just personal improvements. It really can be anything. I mean, you name it, and we can incorporate it into that 203K loan. So why would we want to do this loan? First of all, it's not that complicated. So it's ease of use is obviously available. The second thing is we can expand inventory by taking properties that are being looked over by borrowers. And we can also take those properties where these buyers are telling you that the home is perfect except for a couple of items. Let's fix those items. Okay, there it is for the 203K and rehab loan. Thanks, guys. I have one more slide. Is that what you're saying? Okay, I thought you were telling me I'm out of time. I always go over, so I'm always careful about that. Okay, so contractors have to be vetted and through the normal process. I have several contractors that I've already vetted that are already approved, and I'm referring them, and I'm adding new contractors to that list all the time. Easy process. We take care of it through our renovation team. As a loan officer, I'd be intimately involved, and currently am with all the rehab loans that I have going on. Okay, thank you.
Okay, do we have any questions? Wow, we got a lot answered. Ooh, okay, hello.
It's for you.
Okay.
And I've been thinking about. It's for you, Bill. Okay, so I was thinking about that home that you bought in 2018 for $130,000, and then you sold it for $260 or $265. And I'm wondering what you think the value would be now, based on all that research that you did, looking at all those stats.
I've seen that neighborhood. It's in the 315s already.
315?
315s. And a house that's less, like I did some renovations to it, about $20,000 worth of renovations, the bathrooms, updated the kitchens, backsplashes, floors, paint. So about that much into it. It doesn't have a garage. The other one, but it was converted. The other one did not have a garage at all. Very basic, standard, cabinetry, all of that. So yeah, about 315 on a more standard property now.
Okay, thanks.
I know it is crazy. Any other questions? Any other questions? Yes.
My question is about the home funded program, the crowdfunding. What happens if you don't use the money? Do you have a certain amount of time that you have to use it, or do you use it or lose it?
Good question, 12 months. And if you don't buy a home, then it just goes directly to the loan officer.
Goes to the realtor.
This one is for Ashley. I'm wondering about the income limit for the Section 184.
There is no income limit on the Section 184.
Okay,
There's only income limits on the USDA.
thank you. Oh, and what are those, someone's asking?
It varies county to county. So depending on what county you would look at, there's 3 different levels. It's very low, low, and moderate, and that's where it goes ahead. If it falls within those 3 categories, it does qualify. You can always go to the USDA website, type in an address, and see what county it's in and what the income limits, and also if it is eligible. Or you can just give me a call and I'll give you all that information.
Thank you.
Hold on.
That's my job.
I think you know.
That. No, on the USDA, you said 80% LTV to get rid of MI, right? or does it automatically fall off is what I'm getting at?
No, USDA requires it throughout the life of the loan. It
Okay.
doesn't go ahead and fall off.
Okay, so general question, and which ones does it fall off on,
It's
PMI?
the only one that it's going to fall off is on the HUD 184, the Section 184, the Native American loan. But
Okay.
it doesn't fall off until you're below, I think, like 73%. It
Okay.
is, you have to be lower than the normal 80% for that to actually fall off.
Does it automatic, or do you have to apply?
It automatically does,
Nice,
of course.
yeah.
Anything else? Oh, okay, one more. Oh, we have a mic going to you.
So on the funded, do the buyers, what they are gifted, that is going to be taxed on their annual income, correct?
No, that's not taxed. The reason for that is it's gifted like any other gift. And, they're fine as long as they don't reach the threshold for the federal gift tax. So they can receive that. And the same thing for the donor.
For myself, what is that threshold?
Yes, I know my presentation said it's like 5,000, but it's really like 7,450. So it's been increased.
Anything else? Any other questions? One more.
Hello, this question is for the ITIN. I saw that it covers vacant land. Is there a minimum for that, or is it just a?
Hi. Yes, there is a minimum requirement of 100,000 for vacant land ITIN.
And then for down payment for ITINs, what do you ask for down payment for those loans?
It's going to depend on credit, but the minimum is going to be 15%.
15%. And that's with land as well.
With land, it's a max LTV of 65%, so you're looking at a 35% down. That is a great question, Tigo. Let me look into that for you. It's not in my, if it has to be developed land.
But land for construction and mobile home.
Yeah,
It's good.
vacant land,
Okay.
but no construction loan.
Trailers for sale, right?
Thank you.
But I don't think for the I-10s, but we do the construction loans, but not for the I-10s.
Thank you.
Okay, any other questions?
17,000 is the tax limit is what ChatGPT said for gift tax. So 17,000 is 17,000 is the gift limit.
As of 2024, the annual gift tax exclusion is $17,000 per recipient.
Okay, great. I appreciate everybody for coming out today. Last thing, I would really like to put something maybe on social media for ABCD. So if it's okay with you, I'm going to take a selfie video, and then at the count of 3, we just say ABCD, and we end with a hurrah. Is that okay?